With emerging technologies and market changes, there are lots of opportunities we can take advantage of in the coming years. As the most successful investor of our time, Warren Buffett has managed to amass a massive fortune from market opportunities. Follow his top investing advice for this year, and you'll soon be following in his footsteps. Look for its performance, debt ratio, and profitability. Before you invest in companies, you should look at their financial report to know how they're doing. It's easy to get overwhelmed when you try to understand a company's financial report. According to Warren Buffett, the elements you should look for are its performance, debt ratio, and profitability. For its performance, you should analyze its return on equity, or the rate of income shareholders earn on the assets they've invested. The higher the rate, the better the company's condition. The next element is debt ratio. If the company has too much debt, it can jeopardize its health and earnings, and ultimately, your share. Lastly, its profitability. It shows how much profit the company is making in a given time period. By monitoring these three values, you'll have a better idea of how the company is doing and whether or not you should invest in them. Try to find data for at least the last 3 years so that you'll know if the company is growing or not. One of the most stable and healthiest companies is Apple Incorporated. They've shown growth in terms of all three aspects. Invest in productive assets. No matter the economic condition, it's always a good time to invest in productive assets. Warren Buffett is famously known for not spending money on hobbies, relaxation, or travel. That's because these are mostly consumptive spending, and he knows that your money is better spent on productive assets. Some of the things he considers productive assets are thriving companies, real estate, and farmlands. Although he mentioned investing in real estate, this doesn't mean that you need to buy rental properties or real physical assets. He mostly focuses on investing rather than running it. According to him, owning and managing property should be classified as running a business. And there are too many hassles that could come from being a landlord when your time can be better spent elsewhere. Instead, you should go for real estate investment trusts and watch your value grow without exerting too much energy. One of Warren Buffett's go-to rates is store capital or single-tenant operational real estate capital, which specializes in retail spaces and properties suitable for only one tenant, such as a standalone restaurant or a cafe. Aim for the compounding effect. Warren Buffett is a big believer in the compounding effect, which is the ability of an asset to generate earnings. And these earnings are then reinvested into the primary asset again, which will get you even more additional earnings. This is why he doesn't spend too much on consumptive expenses, because he knows how powerful the compounding effect is when it comes to investment. This principle is applied to his own company, Berkshire Hathaway, which has grown over 3,900,000% since he took over and is now valued at $710 billion. That's why when you have extra income or start making money from your investments, don't just take it immediately into savings or spend it. Instead, practice a little bit of delayed gratification and reinvest it back into the primary holdings, so you can start experiencing your own compounding effect from your investments too. Invest in something that you understand. One of the things that Warren Buffett always emphasizes is that you should only invest in something that you understand. Whether you're investing in the stock market or in a business of someone you know, you need to know the value of the business. It doesn't necessarily mean that you have first-hand experience with the industry, but it should be something that's in your circle of competence. You understand what they sell, how they make money, and how they turn into a profit. That way, you know how their market operates and evaluate their performance. Let's say that you don't understand how non-fungible token works. Then, you should not invest in them or learn more about them before jumping in. Traditional consumer goods company stock might be a good way to start, and some of Warren Buffett's best picks include the Coca-Cola Company and Kraft Heinz. Invest long-term rather than short-term. When investing in a company, you should always look into the future rather than just look at its condition right now. Warren Buffett's principle has always been to buy and hold, and not to aim for short selling. This is appropriate for inflationary periods where you can buy good value stocks as the market dips and hold them as it grows in value in the long term. He was famously quoted saying, "If you're not willing to hold a stock for 10 years, then don't even think about owning it for 10 seconds." You need to put together a portfolio of companies that have increased aggregate and market values throughout the years. One of his long-term investments that you should also look into is Apple Incorporated. The company has always been focused on growing its value in the long term rather than chasing trends, which is something that resonates with Buffett's buy and hold principle. So before you choose your options, always remember his words and think whether or not it's worth holding on to for the next 10 years. Do not follow the crowd. One of the most important pieces of advice Warren Buffett gives beginner investors is to never follow the crowd. In the age of technology, it'll be very tempting for you to go for what's on trend or what everyone else is discussing on message boards. This is something that you should avoid as investors. Instead, focus on what you know and what you value. An example of this is cryptocurrency. Although lots of people are now buying into crypto, that doesn't mean that you should go ahead and invest in it as well. Really find things that you value and invest in those instead. Just like Buffett always said, one of the most important qualities in an investor is temperament. You need a temperament that doesn't take pleasure from following the crowd or going against it. Do not put all your eggs in one basket. Perhaps the most famous of all among Warren Buffett's sayings is "do not put all your eggs in one basket." This statement is still relevant now, since the market is currently volatile and you won't want to rely on one industry. Instead, you should aim to diversify into several different ones. It's a great principle that can be easily understood even by beginner investors. By diversifying your investments, you'll also be minimizing the risks. Imagine putting all your money into one industry. When it all falls down, you'll crash with the market. When you diversify, the average of all your investments will still save you from crashing. Buffett himself has invested in different lines of businesses that he considers to have lots of potential in the future, such as in the consumer goods industry with the Coca-Cola Company, in technology with Microsoft Incorporated, and in finance with American Express. Warren Buffett is one of the wealthiest people in the world, and his principles are generally practical, logical, and easy to understand. Hopefully, by learning more about his investment principles, we'll be ready for this year and earn money from the stock market just like him. Subscribe if you want to find out more on how to earn money by making investments.